Hi, good morning, everyone, and welcome to this webinar with Netwealth on tax year-end planning. We do have quite a lot of you already in, but we'll give it a minute to see if a few more people are joining us in the next minute or so, and then we'll start. So yeah, I'm joined by Gary Horn, who's a client advisor here at Netwealth, chartered financial planner. Myself, I'm also in the client advice team. Between us and our wider team, we help clients develop financial plans. Review those on an ongoing basis, but also provide advice as and when people need it. So some of you maybe looking at taking advice. I'm sure you've spoken to some of us before or are keen to speak to the advice team. So really we can help work with you over a long period of time to develop a financial plan, keep it reviewed, make sure it's suitable on an ongoing basis, particularly in terms of changing tax and regulatory environment. It's quite important to have that ongoing support. Some of you may also be looking for one-off advice, which of course we're talking about. So we're about a minute in, quite a few of you now. Some of you may come in the next few minutes, but we'll start. So yeah, tax year-end planning with myself and Gary. We're looking to look at what are the tax implications of action this year, what are the opportunities. We're going to go into more broadly why we should be investing and the kind of the benefits of investing in stock markets and bond markets and other types of assets compared to cash. How to think about goals, preparing for risk, the kind of tools that we provide at Netwealth. Some of those are free and you can use those as if you're an investment client, and some of you may also be wanting to have a bit more sophistication working with an advisor. We offer both. Also looking at just a general our approach to planning and investing and how we think about those things at Netwealth. So without further ado, we shall start the presentation. So just firstly, who are Netwealth? So yeah, we are a fairly sort of modern wealth manager. We've been going around 10 years now, coming into our 10th year. We wanted to have a slightly different approach to as a company. So Charlotte and Tom, who were partners at Goldman Sachs and at JP Morgan respectively, wanted a company where they could feel confident of managing their own money. So it was about being more transparent, being more efficient, having lower fees, and having a more simple approach to investing. So rather than having hundreds or even thousands of funds and shares available, we want to have a centralized investment proposition with a very strong investment team who manage the portfolios on your behalf on a discretionary basis, keep fees low, have a very robust process, so kind of avoiding mistakes, making sure that we're being proactive in navigating the market, and also having advice available for people when they need it. So advice is optional. We believe that in that flexibility to make sure people are paying for what they actually want. So some people just want to invest, others want investment and advice. We can be flexible in giving that and change the service as well over time. So we have an expert team of advisors here, of which myself and Gary are part of. Just very quickly, the budget in 2024. So that did change the landscape somewhat for most people. Up to that point, people were looking at their pensions, particularly for inheritance tax savings vehicle. Unfortunately, pensions were brought into tax, inheritance tax in that budget, so from April 2027. Whereas before, people could save their pensions and spend that if they wanted to, so for their own income in their lifetime, or save that for their children or grandchildren or nieces or nephews or other relatives, siblings, charities. It was tax free. It's going to come into the inheritance tax sort of spectrum at that point. So quite big changes. So that's one of the main tax changes which people are going to need advice on and some planning over time to kind of alleviate that. Again, more stealth taxes. Tax thresholds were frozen, so the basic rate band, pension tax allowance, high rate band, all frozen. So all of us are paying more tax. Also, capital gains tax went up a little bit less than expected, but still quite significant, particularly for basic rate taxpayers. So it went from 10 to 18%, and 18 to 20, sorry, 20 to 24 for high rate taxpayers. And of course, some of you will be experiencing the changes in VAT for private schools as well. So quite a lot of changes in the budget. It does mean that tax planning becomes just even more important, particularly the long term around pensions, especially, which is I think the main change for most people's long term plans. But certainly in the short term, we're all going to be paying more in income tax as a minimum, and some of us will be paying more capital gains tax as well. So having a plan really is very crucial. So what are the things that we can really do to help that? So the main thing is really using our tax allowances. We all get ISA allowances, pension allowances, capital gains tax allowances. If we can use those every single year, that just can keep us being really efficient save money basically. So the main things we're going to look at today are ISA and pension allowances, but there may also be some other opportunities there, particularly around capital gains tax, which we'll touch on. The other thing is just making sure that you're invested in the right way over the long term. So again, keeping fees low to keep more of the returns that you have, and staying invested, not being too reactive. So we can think about what's happened in the last few weeks in the US market. While that has an impact in the short term, longer term, that doesn't actually change our goals, our needs, and what we're looking to do. So about staying in the market, and we'll look at why that's important in the next few slides. So the main thing that I think a lot of people will be looking to do, at least this month, because a lot of you will already be saving into a pension, particularly through a workplace or maybe through your companies. Make sure that you're using your ISA allowances. So for adults, that's £20,000 each. So for a couple, that's £40,000. Some of you may have children. You can put £9,000 into a junior ISA. So you can actually shelter quite a lot of money into the tax-efficient ISA wrapper if you have that cash available, or maybe you have money in a general investment account. So a lot of clients at Netwealth, they will be using their pension, their ISA allowances with us, and we'll be working with them to do that. But if they have more money available to invest, which many people do, they might put that into what's called a general investment account, and that is a taxable account. Within the general investment account, you can still use your capital gains tax allowances. So that's £3,000 per person. It's not a lot. It was 12,300. It went down to 6. Now it's 3. But at least for a couple, that means £6,000 of gain can actually be sheltered from tax. And by rebasing that every year, you can increase the base cost of your portfolio and reduce the long-term tax implications, particularly when you start drawing it down. You also have dividend allowances, which should be used, and maybe some interest allowance too, but some of you may already be using that on your cash. So outside of the GIA, moving money into the ISAs or from cash is really important. Pensions as well. So although they have made the changes that I've touched on the last slide around inheritance tax, it's still a great way to save long term. It's very tax efficient, and the main reason it's tax efficient is you get tax relief going in, so it's gross investment. So you get compound growth on the gross amount of your investment. So there is no leakages in the investment cycle. With ISAs, you're putting in money that has been taxed. So it's come out of your income potentially. You've paid income tax on it. It goes into the ISA. It grows tax free. You withdraw it tax free. With the pension, it's slightly different. It goes in gross. It can compound gross, and then you pay tax at the end. And generally, paying tax at the end of an investment rather than the beginning typically leads to better outcome, because you're getting growth on the larger gross amount as opposed to the post-tax net amount. So you can get money into your pension gross before tax. And then if you've paid tax on that money, you can get tax relief, so you can claim it back in your tax return. So all of you have a £60,000 annual allowance. Some of you may be tapered. We won't go on to that too detail in this call, and so in this webinar, but do feel free to contact us if you wanted to look at whether you are tapered. So you'll be tapered if your income, your adjusted income, is between your total relevant earnings is between 260 and 360,000 pounds. There are also calculations that impact the adjusted and threshold income, so it's important to understand how that works. The minimum that you can be tapered to is £10,000. So some of you may have a high income above £360,000, in which case you will only be able to put £10,000 into your pension. But definitely speak to us on that just to check. You've got a couple of weeks until you can sort of make that contribution for this tax year. So definitely speak to an advisor sooner rather than later if you have a question on that. But otherwise, £60,000 can go into a pension, and that's very powerful savings mechanism, because that's money going into a pension. It's still outside of your estate for inheritance tax for 2 more years, so it's still got those 2 years of benefits. It's going to grow tax free. Also, when you take the money out, you can take a quarter out tax free as well. So that just compounds the benefits of saving in the pension. The government's position is that pension should be used for retirement income. And so if you are going to be using it for that, and most of us will, then it's just a great mechanism, a great tool to use to do that alongside your ISAs. And in terms of sort of retirement planning as well, alongside the ISA planning, the pension planning, you may want to think about your wider goals as well. So if you haven't got a financial plan or you're thinking about it, then do start thinking about that. And the pensions and the ISAs will definitely form the spine really of that plan. alongside a few other things. So really, why invest? And this is kind of the question that most people start with, and a lot of us start this on early on in our investment journey. Our first job, for example, you get a pension, um, somebody it gets opened for you on your behalf, or whatever it might be. You've got surplus income over time, and you save that. But really, why investing is important. I think it is important just to reiterate this message for people, because people can get quite caught up in the market cycle, the news cycle, what's going on in the political realm, what's going on with inflation and interest rates, see bad news, and it can put people off. But I think this chart is quite helpful just to look at the kind of the dichotomy between cash and investing. So here we've got a cash line, so the dark blue, starting in kind of in the middle of the financial crisis of 2007, starting in 2007, and then we've got a balanced, medium risk, not too adventurous portfolio in the light blue. So that's our risk level 4, basically. What you can see here is over the long term, so over the sort of 2027, 2024, kind of 17 years there of investing, you clearly can see the benefit of investing in the risk level 4. So this is the real value of that money over the 17 years. So if you had £100,000 in 2007, if you just left it in cash because of inflation, between inflation and the returns on cash, the real value of that money has gone down to £66,000. The real value of the invested portfolio is £115,000. It's 15% better off in real terms. The journey, though, isn't smooth, and I think this is what's important to highlight for people. So although the journey is not smooth, you might say, okay, well, maybe I can be a bit more cute to try and time things. So you might say, okay, well, what if I left it in cash between 2007 and 2009? So between 2000 and 2008, when the market bottomed out and kind of in 08, what if I was clever enough to find that bottom and then go in? In practice, it is very hard to do that. So um, in reality, if you sold out in 2007, went to cash, it'd be very hard to know exactly what point you should have bought back in the market. So that you sold at the right time at the peak in kind of 06, or early 07, or buying in again at the trough in 08 before it starts to really recover strongly. So it's very hard to do that. And you can see on this journey, there's lots of volatility. So in any given year, if I look at 2014, it went from being worth nearly 120,000 down to around 110,000. So again, quite a large drop in real terms in that point. And again, you can see that happening again in 2019 and 2020 in particular with COVID. So there is volatility, but over the long term, if you stay in the market, you are better off in real terms. And the difference between doing nothing and investing, is huge there, sort of 50 or 60,000 pounds. So yeah, the message really is hard to time. We always try and do our best to do that. But really, our philosophy is if you're staying in the market, if you have in this case, a 20-year time horizon, for example, um, even though there is going to be some volatility and there could be some market crashes in that time, if you stay invested for 20 years, you will grow your wealth. And if you don't do that and you sort of delay action or stay in cash too long, the real value of your wealth will go down. So it's important to invest. And just to point out that volatility point. So the grey part of the bar is the end of year returns, the calendar year return at the end of the year. The blue bar shows the biggest fall in the value of the investment or the stock market, which is for the FTSE All-Share. So think about the FTSE 100. Within that year, the blue shows the maximum fell in that intra-year. And as you can see, pretty much every year has points where the market is down from where it was at the beginning of the year. So if you look at 1995, for example, it followed a very poor year, 1994 overall, where the market fell. It finished the year about 6% down, but at one point it was about 17% down. Usually when there's a market fall, no strong performance does follow because you get a correction in valuations. You bring down some of those kind of astronomical valuations, you get down to a kind of more normal level, and then you get more confidence moving forward. It finished the year about 6% down. The following year, there was still a period where the market had fallen 4 or 5%. So people may not have thought that was the best time to go back in. They might have thought, okay, I'll keep waiting. But it ended the year, over 20% up. But then you had a solid 5 years of strong returns. You have the dot-com bubble. So you have falls in 2000 to 2003. Again, if you were able to sell at the peak in 99, come back in at the bottom in 2002, fantastic. But if you weren't able to time it perfectly, staying in the market, you still would have been better off over the next 5 years. Again, you had another 5 years of positive returns before it dropped. Now, if we look at the 2009, that finished with the best overall performance, so 30% up in that calendar year, again, following the 2008 crash. At one point, though, it was still down more than 20%. So it kept falling until about the middle of the year, and then it started shooting up. Again, if you weren't able to buy back in at that moment where it switched, you would have missed out on that 30% gain. So even in strong years, you can see how much volatility there can be in the stock market. So it's important to understand that it's fairly normal to see intra-year drawdowns of up to 10%. It's not that uncommon, and even 30, even 20. So there can be volatility within the year of plus 10, minus 10. So it's important just to stay kind of focused on what you're investing for the longer term view. And that market can shift quite quickly. So it is important to be in the market to make sure that you benefit from those shifts. And just finally, on this point, just to reiterate the point about time in the market, not time in the market. So this shows the S&P 500 from 1987. So there was quite a large crash in 1987. In that time, the returns of the American market have been exceptional. But again, you can see how volatile it's been. So there has been large periods where it's fallen, it's gone down, drops again in the sort of mid 2000s, quite large, sharp spikes, in 2020 for COVID, the war in Ukraine, high inflation, interest rates going up, a loss of confidence. Again, it took a few years to recover from sort of 2022 falls until now, and then you've seen it go right back up again. If you'd have stayed in the market from 1987 to now, you would have seen returns of over 5,000%. If you missed just 10 days in that period, so the top 10 trading days, so the days of the largest one-day jumps, which could be 5, 10, 20% in one day, as you've seen in the previous slides, if you'd have missed out on those 10 days, your returns would be half, less than half what you would have got if you'd just stayed in the market. So it shows how sensitive the days are and just how hard it is to time the market. So, if you're able to buy in on those days, those 10 days of, 40 years nearly, 10 days and 40 years, it's like less than 1% of the day. It's a fraction of the 1% of the day. So it's very hard to do that. So we just believe be in the market with the right asset allocation for your needs and ride it out if you have that time horizon. Realistically, if you don't have that time horizon, so less than 2 or 3 years as a minimum, then you shouldn't actually really be in the market. So you'd be in a different basket of assets. So you wouldn't want that volatility. But for long-term investors, being in the market is the right thing. So where to start? So we think of it in terms of 3 pots. So we talked about the 3-pot theory before. Pot 2 is really where we at Netwealth believe that we can help. So that's your core wealth, your pension, your ISAs, your general investment accounts, your multi-asset managed portfolio, and that sits alongside your cash pot, so your cash reserve, and also sits alongside your longer term kind of illiquid assets, so your main residence, maybe your buy-to-let property, your direct shareholdings, maybe at the company you work for. We don't want to get too involved in those pot 1s and pot 3. Of course, we'll factor it into our advice and we'll give an opinion. We'll make sure that you've got a sufficient cash reserve. We may talk about maybe it's at the right time to sell some stocks or whatever it might be. But really, your pot 2 is going to be the core of your long-term, the core of achieving your long-term objectives, things like retirement. So we think that should be managed professionally. That should be liquid, it should be low cost, it should be well diversified, and that's where we can help at Netwealth. That the mix of the pots will change over time. People starting out on their investment journey will likely have more pot 1 and a bit of pot 2. So they're saving really for a deposit on a house, so they're building up a lot of cash. As they get into their career and they bought their property, you're going to start to see so your pot 3, that's kind of your property initially. That becomes your main asset. As you're going through your career, what you want to see, and as you're making pension contributions, you're building up ISAs, you want to see that pot two get bigger as a percentage of your assets. So by the time you retire, kind of in your 60s, 70s, maybe even earlier, some of you, um, that's probably your largest asset. Other than your main home, your pension and ISA portfolio should be really your largest asset, and that's what you're going to live off. That's your liquid um, source of income. And then as you spend it down, you'll probably start to see you kind of get closer back to where you were in your 20s, where although with a large property, maybe a smaller pot too and some cash. If you do find you're having a large estate remaining at this point, this is where estate planning, working with an advisor, giving away assets, maybe building trusts, that can really help. In terms of kind of again what we can control. So as we talked about, the long-term return really matters. So being in the market, so we can't necessarily control short-term volatility, but we can control the right asset allocation for the long term. We can't control inflation. We can try to alleviate it by thinking about and being cognizant of it, but we can't really control what's happening with inflation. We also can't control our mortality. You may find that you actually need income for longer than you think. So some people might be planning to 80, 85. We think planning to 95 is more prudent, just to make sure that all eventualities are considered. So there are things we can't control, but we can try to think about, okay, how can we mitigate the impacts of that? So we really want to look at what we can control. So it's time in the market, not timing the market. It's having the right asset allocation for the right time horizon for you. Be diversified. So we don't want to put all our eggs in one basket. We want to be, we want to be in the US. We want to be exposed to some of those great companies, but we also want to be in the UK. We want to be in Europe, which is doing great at the moment. We want to be exposed to Japan and China, different types of bonds, corporate bonds, government bonds, gold, etc. We want to be diversified, making sure we're getting returns from all types of assets, but we have some inverse correlation there. So we're not always exposed to what's happening in the market. Actually, our diversification can mean that you can have a smoother journey as different assets move in different ways, and the returns aren't always consistent. So sometimes some assets are doing very well, but if those assets aren't doing particularly well, we're diversified and we have other assets that can do well. The other thing, and this is clearly what we're talking about today, really is utilizing tax wrappers. So using your ISA every year. If you don't use it, you will lose it. With a pension, you can use carry forward, so maybe you can do a larger contribution, but it's still good to use the allowance when you can. But really utilizing those allowances is so important. Minimizing fees as well. So choosing a type of investment, a wealth manager, whatever it might be, a platform, a pension provider, choosing somebody that is going to charge you less, basically, without compromising service. And every small amount you can save really does get added onto your longer term return, and that's something that Gary will look on a bit later. So setting goals and thinking about risk. So is it for a specific need? So there'll be different pots for different purposes. So you might have an ISA pot, which might be for a short term. You want to buy a property, or maybe it's to pay off a mortgage, or maybe it's you want to give some money to your children. That might have a different goal than your pension, which might be much longer term. So let's say you're 45, you might not be retiring for 20 years. So your pension might be in a higher risk portfolio, maybe a risk level 7 or risk level 6. Over the 20 years, you want to get as much growth as you can. So you want to be exposed to equities. Because you've got the time horizon to do that, you can absorb some of that volatility over the longer term. You might have an ISA pot that actually you want to use to pay off a mortgage in 5 years' time, for example. You might want to take less risk with that, because if you take too much risk, it can fall in the short term, as we've seen on some of the previous slides, and then you can't achieve your goal. So think about what is the goal for, and making sure that you're taking the right level of risk for that goal. It could be an unknown thing, a rainy day, and again, you might want to consider, well, how much risk do you want to take with that kind of emergency fund. So setting goals is kind of really the first step. And then it's picking the portfolio. So at Netwealth, we have 7 risk-rated portfolios. We also offer those 7 portfolios in euros, dollars, also SRI, which is socially responsible investing. Some of you might be minded that way and think about investing ethically. So we offer that as well. Say more ethically, I would say. Just it filters out certain types of companies. So picking the right level of risk, or working with an advisor to take the right level of risk. At the lower end of the arc is cash deposits, so it's very low risk. We're getting cash returns, almost no risk of loss. but of course there's inflation, and it won't beat inflation over time. This is probably short-term need, um, or maybe just an emergency reserve to sit alongside your high-risk assets. As you go up the spectrum, you're increasing your allocation to equities and bonds, and also alternatives like gold and commodities. Um, in the middle, you're getting a balance really of bonds and equities and alternatives. As you go the other end up to 7, it's really equities, and these are the drivers of return and also risk in portfolios, as you're getting the value created by companies. So companies can grow exceptionally fast. You've seen if they have a great product that's scalable, you can see huge returns in a short period of time. You don't get those returns with other types of assets that are more defensive, like bonds. Even gold and other commodities are unlikely to grow at such a high rate in a short period of time. You can get that with equities, but of course that comes with higher risk. So when we are taking that level of risk, we want to make sure that it is for the right reasons. You've got the time horizon, you have the risk tolerance, you have the ability and capacity for loss. Um, so those are the portfolios that we devise for our clients. And you may be in a blend of them. Um, and what that looks like in terms of the risk and the volatility. So the longer term return, as you see in the middle, but as you can see, the range of returns can vary hugely. So the risk level 7 has the potential to grow, over 40% in a single year period, typically after a market fall. And as markets recover, because it's mostly in equities, it's capturing the return of those equity markets as they rebound. But it does have the potential also for large falls too, so sort of 28% in a worst case scenario. So as you go up the risk spectrum, there's more potential for growth, and these average returns are kind of over a longer period than we've been around. I think we have a slide later showing the actual returns, and um, they are different to this. This is kind of a potential return on average over a longer period of time on a similar asset allocation. But as you take more risk, the average return will go up, but the range of returns will vary. So this risk level 7, it could there's a sort of 70% gap there, sort of range it could be within. At the other end of the spectrum, the risk level 3, for example, it's a kind of 25% range, so much tighter, less deviation from the mean, but really less opportunity to grow. So you just want to make sure that you're in the right portfolio for your needs, and being cognizant that range of returns will widen as you take more risk. And you see here as well that the chances of losing money in the short term is very high in all portfolios in a 1 month period. If you were to invest even in the risk level 2, there's a nearly 35% chance that after 1 month it may be down from where it was. But over 6 months, that the risk of losing money falls significantly to 15%, and then 10% after a year. And then after 5 years, is really, at least historically, no risk of losing money with a low risk portfolio like a 2. Equally, the risk level 4, even after 5 years, it's very unlikely you may have lost money. But there is the chance in the shorter time periods of 6 months, 1 year, a few years. The risk level 7, even after 5 years, there's still a 15% chance that it could be lower than it was when you started. But after 10 years, that risk goes away as well. So the more risk you're taking, the more likely that you could be impacted by short-term volatility, and that short-term volatility is more likely to impact a higher risk portfolio with a basket of equities mostly, where those individual companies can go up a lot, or they can go down, and some companies can go bankrupt, for example. So again, just reiterating that point around time horizon and risk tolerance. And I'll just quickly show a case study now, just to do some modeling. So if I just change the screen that I'm sharing. Give me a sec. Okay. So bear with me 1 second. So I just want to show what it looks like to model an account at Netwealth. So this is a demo account. This does actually track a real client. If you were to be a client, this is kind of what it would look like. You have your accounts all in one side here. You can see your asset allocation, you can check your performance, etc. If we build a portfolio here, I just want to show what it looks like to build an ISA and then compare that to a GIA that's taxable. So if we just go just invest and we look at a 20-year time horizon, for example, if you were to put that in an ISA, you would see the maximum contribution this year, so £20,000, do a monthly contribution moving forward to use up that allowance. And because we've got a 20-year time horizon, we're probably going to be wanting to take a bit more risk. So we're looking at kind of maybe 5, 6, or 7. For this one, I'm going to go with a 7, because if you've got a time horizon of more than 10 years, you probably want to be thinking around that. You may be thinking about a 6. It's not too dissimilar. It's just got a bit more diversification. So while it's got mostly equities, so 75% equities, it still has 15% of fixed income, and 9% in alternatives, which is gold, commodities, and some derivatives. So that might be an option. I'm just going to go for 7 because that's 90% equity, and some alternatives there as well over a 20-year period. I'm going to try to get the returns on equities, and I've got the time horizon to do so. So if I just click next, you can see what it looks like over time. So in an ISA, over 20 years, putting £20,000 a year in, so that's over 400, including this year, so 400,000 plus of contributions, plus 20 years of growth, with an average annual return of just over 6% in a risk level 7. That may grow to 840,000 in an average scenario. Even in a weak return scenario, it's still larger than if it was uninvested. So you've still got a £50,000 difference there, even at 1% returns. And very strong return scenarios that you could be looking at over $1 million. So if you're, starting to do this, let's say you're 40, or 50, over 20 years, you could realistically save up quite a lot of money in there from investing there. Even if you took a lower level of risk, a bit more cautious, a 5, so kind of a 60-40 portfolio. Maybe you're not sure that you definitely want 20 years. There's a chance you might take it out earlier, in which case you probably want a bit less risk. Even at the 5, you're looking at maybe £700,000, £469,000 in the weak return scenario. So still better than if you hadn't invested. One of the reasons why the weak return scenario is slightly better there is because the range of returns are lower than in the 7. There is some bonds in there. There is some alternatives. So you're getting a less potential for losses essentially in that time, but less potential for gain on the average. If I just compare that to a GIA, so just showing that sort of the power of investing in an ISA, so 729 on the ISA there. If I switch that to a general investment account and assume you're a high rate taxpayer, over the same period of time, you've lost this down to £547,000. So the combined impact of paying tax on the growth and the income, and also how that reduces potentially the value of your pot each time that happens, you've lost about £180,000 of return over 20 years. So it does make a huge difference. The same thing will hold true for a pension. So hopefully that kind of shows the importance of doing that. I'm now going to turn over to Gary, and is going to carry on the presentation. Thank you.
Thanks very much, Fred. So just stop sharing Fred and I'll share my screen. Great, thank you very much. Okay, so I'm now going to be taking a bit more of a look at our investment process, taking a look a bit more under the bonnet in terms of what our portfolios look like. I'm going to be explaining a bit more about the overall Netwealth service, both our core service and our financial advisory service. I'm going to be looking at the sort of performance and the fees that clients pay and the way we can help clients. So firstly, just looking at the importance of a robust investment framework. So at Netwealth, we have our own in-house investment team, so highly experienced investment team, backgrounds in running institutional funds. In terms of the way we construct portfolios, so we're very much of the ethos in terms of proactive management of the asset allocation, i.e. how much we allocate across the different asset classes, but then our approach is to implement the strategy in terms of the underlying investment through low cost passive funds. So first of all, in terms of the main pillars of our investment process, let me go through those now. So first of all, we have our strategic asset allocations. Okay, so basically on an annual basis, these are reviewed. Our investment team sort of get together, formulate their views. These are our medium to long term views of the various asset classes. It's essentially taken into account current valuations of the various asset classes, the current economic climate, geopolitical issues, and on how we see over the next 10 years different asset classes performing. It's from that point we build our first strategic asset allocations. These strategic asset allocations are not changed frequently. Okay. We then have our instrument selection. So the way we actually invest, well, first of all, we'll do our due diligence on the relevant fund managers to pick. We're making sure we get the relevant exposures we wish. Okay, so which markets we're wishing to invest in, and we tend to invest in highly liquid funds with a low cost. Now, as I've mentioned earlier, we tend to invest in low cost passive funds, generally ETFs, so exchange traded funds, which are listed passive securities. And the reason why we take this approach is principally because asset allocation in terms of proactive management of that is what is driving most of the investment returns for portfolios. But then we firmly believe on low cost implementation, which then acts as a massive tailwind to our clients' performance, and that obviously in terms of the net return to clients, is very helpful. And I'll show you our investment performance figures shortly. Finally, we have our cyclical positions. So all of our portfolios, they're managed by our investment team. So they're discretionary managed portfolios. So they're managed daily. Changes are made on clients' behalf. But we also have our cyclical positions. So we have a monthly investment committee meeting where any decisions that are put forward by the investment team are ratified or otherwise. And essentially, these cyclical positions are all about mitigating risks. So these are positions taken away from our strategic asset allocation positions. And what this is all about is if the investment team can see obvious ways to smooth out the path of the returns for a particular given risk profile, then they would take positions that are away from those strategic asset allocations. And now this will be about analyzing, data, economic data, what we're seeing going on in financial markets, and that's what our investment team do. But the main thing is we're building core investment portfolios for clients which are highly liquid, very diversified, and then with the ethos of keeping cost effectiveness for clients in terms of the investment portfolios. So this next particular chart I'm now showing you is just to really demonstrate the benefits and importance of diversification. So we tend to refer to this particular chart as a sort of a quilt diagram. And what we've basically got here is throughout time, we've essentially ranked what the different asset class returns have been from top to bottom in any particular calendar year. And in addition to that, we've also detailed in this chart the Netwealth risk level 4 portfolio. So the risk level 4 portfolio is a broadly balanced portfolio in terms of roughly 50% equities and more cautious asset classes. Now, the real reason for showing this chart, as I say, is to show you the benefits of diversification. As you can see from the color coding, there is no real obvious correlation. It looks quite random, which it pretty much is. But what you can actually see is if you look on the middle of the chart, which is basically you can see the Netwealth portfolio, which is the white shaded rectangle, is basically what you can pretty much see is throughout time that balanced portfolio is sort of like just bumbling along sort of middle. So even though that you're seeing the extremities of the various asset classes, where, you know, for example, you've got emerging market equities, 2009 highest, 2011 lowest, diversification, having exposure to different asset classes, being carefully managed can help smooth out the path of the returns and gives a far more sort of considered approach. So there's that. Um, in terms of now just looking a bit more underneath the bonnet in terms of our portfolios. So as Fred has already mentioned, we have 7 different portfolios, 7 different risk profiles. So risk levels 1 through to 7, with 1 being the lowest risk profile and 7 being the highest. And in essence, the main difference between the portfolios is as you go up the risk spectrum of the portfolios, you will find there's more equities. So we start off with the risk level 1 portfolio. So that's actually our liquid reserves portfolio, which contains 70% in money market funds and around 30% in ultra short dated bond funds. So no equity market risk at all. But as you gravitate towards the right, what you can actually see as more and more equities that are being introduced into the portfolio until you get essentially to the risk level 7 portfolio, which is pretty much full on risk assets. So mainly equities, some emerging market debt with a small amount of allocation to commodities and just a very small amount of cash. Now, as Fred's already mentioned, as to what is the correct portfolio for you will ultimately be driven by your objectives, and you may have various objectives and numerous objectives, i.e. for different parts of your portfolio. So it may be, for example, that your pension has a longer investment time horizon and there should be invested with a higher risk level, whereas, for example, your general investment account and ISA, which may be the part of your portfolio which you draw down in the first instance, should be invested at a lower risk level because of the reasons Fred's demonstrated in terms of market volatility and a shorter investment time and therefore risk of loss in the short term. These are the type of conversations and things we can help with in the advisory team. If clients need advice, we can recommend how they should be invested across the portfolio. And then finally, just on this second chart at the bottom is basically showing the currency exposures within the portfolio. So risk level 1 is purely just sterling denominated, so no foreign exchange risk at all. Again, risk level 1 is likely to be needed for more short-term needs, and therefore taking any foreign exchange exposure is not likely to be sensible. But as you move up the risk spectrums, we introduce more equity exposure, more foreign currency exposure, which is obviously going to present the opportunity for sort of different returns, different return profiles, but also does introduce that element of exchange rate risk as well to the portfolios. Okay, this next chart, which I'm just showing you here, is the relevance of bond allocations or fixed income allocations within portfolios. Now, we've had quite a few more questions and conversations over the last couple of years in terms of the relevance and do bonds or fixed income securities still have a part to play in portfolios? And we firmly believe they do. Most of these questions essentially came about as a result of sort of this particular year, so 2022. So if you recall, that was the start of the Ukraine war. Inflation was starting to pick up, and both equity markets and bond markets were impacted, and therefore impacted client portfolios, and therefore clients question and essentially whether fixed income still plays a part. The real reason for showing you this particular chart is basically what we've got here is over time, over the last 25 years, is the maximum equity drawdowns on global equity markets over those periods. And really what we're showing here is for those maximum drawdown periods, those maximum 12 months intra-year drawdowns on the equity markets, we're also mirroring what fixed income markets did at that point. Now, the point being in here, and Fred touched on it earlier, is that fixed income markets tend not to be correlated or certainly have some inverse correlation to equity markets, and therefore when our equity markets are being impacted, that the fixed income element of your portfolio tends to provide a cushion and protection from those falls. So we certainly do believe they still play a very important part to portfolios. The other key thing as well, within the fixed income part of a client's portfolio, we can also manage what appropriate exposures a client should have. So just I used the 2022 example earlier, where both equity markets and bond markets were hurt, but we can manage what relevant bond exposure a client should have. So we were very much short duration at that time, which actually helped protect client portfolios during those times as well. Okay, so this is picking up on something which Fred mentioned earlier as well. So just the importance of fees. So our ethos at Netwealth is firmly on cost savings for clients, both in terms of the overall cost which clients pay. So that's the fee that clients pay for Netwealth service, which I'll come on to shortly, but also the underlying investments, which I've already talked about. Now, what this particular chart is just really showing is over basically a 20-year period, if an investor had invested 100,000 and they're earning a 5% assumed annual return, if they're paying 1.65% total fees with a traditional wealth manager, and just for example 1.05% with Netwealth, what the impact is over time. Now, we tend to find that clients can save anywhere between half and 1% or more investing with Netwealth, and sometimes clients think, well, it's only half percent, it's only 1%. It doesn't actually seem much as a percentage term, but the real importance of this is the compound impact. So basically, just in this example where the client's basically saving just over half percent a year, over that 20-year period on £100,000 invested, you can see the significant difference on the end result. So basically, you're looking at just over 30,000 there in terms of additional return. So there's a real meaningful impact just by a small fee saving on an annual basis as a result of compounding. Now, in terms of our investment performance, so what we've got here is the Netwealth portfolio investment performance to the end of last month, so the most recent published data since Netwealth's inception, so back in May 2016. The navy bar charts are the Netwealth portfolios, so we've got risk levels 3 to 7 there. Risk levels 1 and 2 don't actually have a relevant ARC comparator, but the grey charts are the ARC average comparators. Now, just to explain what ARC is. So ARC stands for Asset Risk Consultants. It's an independent consultancy. They collate real data from most of the main wealth management players. There's over 130 members. They then collate the real data, benchmark your portfolios against the relevant ARC average. And so what this chart is basically showing, across all of our risk level portfolios, we've outperformed after fees the relevant ARC average. And as I've mentioned, risk levels 1 and 2, because they're so low risk, they don't have a relevant ARC comparator. This chart is now showing the since inception returns of all of the Netwealth portfolios. And basically what you can see is the more risk you take, the higher the longer term return, but the more volatile the journey. So just as an example, if we're taking the navy line, which is the risk level 7 portfolio, you can see back when the time of COVID, the pandemic back in March 2020, the risk level 7 portfolio was hit the hardest. But then when markets recovered, you can see that bounces back the stronger. If you have the relevant investment time rising, you can afford to take the risk, and it's right for your objectives, and we can help you make these decisions as an advisory team, then the higher the longer term potential return on your portfolios. And just to add, these are all net of fees. Okay, so just to explain about the sort of the Netwealth approach in terms of how we go about things. So as Fred has already mentioned, we're a modern wealth manager. What we've actually done is to absolutely embrace technology and use that to generate operational efficiency, so do lots of the heavy lifting, keep administrative aspects very cost effective. It also provides lots of tools in terms of financial planning tools, either which are available to clients just to use online. So Fred's already demonstrated the account opening online modeling tool there, but there's also tools that we have available to us as advisors in terms of lots of our wealth projection and cash flow modeling tools. So we use that technology to our advantage, but the main thing is it's all overlaid by keeping the human elements which clients value and what we think is important. So essentially, we have humans, professionals managing our money. I've already mentioned the investment team, but also the financial advisors such as myself and Fred, which are providing the financial advice to clients. So basically giving clients still the bits which they value and need and are important in terms of our overall process. So we can help clients develop their financial plans, but using technology, we believe this helps to deliver a sort of an overall better outcome for clients. So just to explain the parts of our service, so we have two key elements to our service. So it's the core investment service or the advice service. So basically, the main difference here is both elements include the investment management of portfolios. You've got access to financial advisors for guidance calls and our online modeling tools, and also attendance to webinars such as today. The key difference between the core and the advice service is that the advice service includes formal regulated advice. Okay, so we typically provide an initial report, have half-yearly review meetings with a client to get an update on their situation, to make sure we can then provide advice as a client needs. And obviously, we'd also contact the client in between half-yearly reviews if advice was required, i.e. that can tend to be driven by maybe changes in pension or tax legislation. In terms of the fees, so basically the difference here, so essentially we've got our four fee bands here. So up to 250, it's 0.75, 250 to a million, 0.6, 1 million to 5 million, 0.45, and over 5 million is 0.35%. That fee is charged on the whole amount. It's not just, as you move into the next bracket, you pay that on the whole amount. All of these fees include investment management, custody, transaction charges, administration, and VAT. So this is all charges. So it's been very transparent about what clients pay. And then just on top of the Netwealth investment management fee, we just have those underlying fund charges, which can range from 0.1 to 0.45%. Now, with the advice service, this is the ongoing advisory service, is the one I've just referred to on the previous slide. We've basically got 0.35%. So that's the cost of that service. So overall, a very cost-effective way of investing or receiving financial advice. Okay. And then just to quickly explain in terms of the advice options which are available to clients. Now, Fred mentioned this earlier, so I've already just discussed how clients can be an ongoing advisory client. So that's more akin to what would maybe one consider a sort of a traditional relationship, but we can also offer advice on a one-off basis if a client so wishes. So basically, what we would do then is we would discuss the client's requirements. agree the scope of work, agree a fixed fee quote, and then provide that to the client. We then discuss the report, address the conclusions, answer any questions that the client has, and then that would be the end of it. And we'd obviously help them implement the advice with Netwealth if that's what they wish to do. Um, and that would be the end of it until such time they wish to recommission further one-off advice. We also offer our ongoing advisory service, which I've discussed. Now, it's possible for clients to change between services as and when it meets their requirements and needs. Okay, and then just to really sort of wrap up again, just to like reiterate what Fred has mentioned earlier in terms of in key financial planning points. We firmly believe on keeping financial planning fees low, the importance of using tax allowances as wrappers, and we can help as an advisory team on that, and then really just the importance of being invested for the long term where you are able to. We can help clients develop financial plans to sort of navigate changes in their financial circumstances. Um, Typically, when we speak with clients, we will the first thing we will be doing is understanding their financial goals. And as I say, they may have multiple goals in their situation. Some may be more short term, such as saving for a deposit on the house, and some may be more longer term, i.e., saving for their retirement. But that's our financial planning. That's typically what we would be helping as a financial advisory team. Our financial plans, though, will help provide clarity to clients. They can visualize why they're taking certain decisions now and how that's going to meet their needs over the longer term. Okay, so just to wrap up now. So these are typically some of the things which might drive clients to contact us. It could be that they're both working full time. Can they afford to retire? That's quite a common one which we're talking to clients with. Retirement planning as a key piece of the work we do. Whether they can afford to buy a bigger house, is that possible? And just building out plans around maybe changes in their work situation. So we're here to discuss individual client situations and help them navigate any changes in their situation and build out a financial plan from that point. Okay, and then just this final slide is just to give an overview of our financial service, i.e. the key things which we tend to help clients with. So basically we can help on asset allocation decisions. So as mentioned earlier, it could be that a client's invested in a different way across their portfolio, and that will be generally driven by different objectives for different parts of the portfolio and therefore investment time horizons. Retirement planning is a key part of the work we do in terms of if someone's either approaching retirement or they're just entered into retirement, what does that look like for them? The right way to be drawn down on their portfolio for tax efficiency. We quite often when a client joins us, we can help with pension consolidation. It's not, or it's very typical for a client to have built up, several pension pots from different workplace pensions. So we can review them and help consolidate them, which from a sort of a holistic point of view is going to help moving forwards to make sure they're invested in the right way. But also when it comes to the point of drawing down, it's going to make things administratively a lot easier for the client. So we can help with the drawdown strategy, income and asset analysis, pension planning, whether it be around pension contributions. Fred has already mentioned we can help advise on how much a client can contribute to their pensions. Bespoke cash flow modeling plays a key part in our financial planning. So we typically include long-term wealth projections in our financial plans just to help clients visualize what the future looks like. And then finally, as Fred would have mentioned earlier, what we tend to find with our wealth projections, if there are significant assets still remaining at the balance sheet, that can tend to lend itself to estate planning opportunities for clients at some point, whether that it might be later on in life, but just really depending on their situation, and we can help clients with that. So that's it. So I'm just going to now hand back to you, Fred, if that's okay.
Yes, thank you, Gary. Are you able just to leave the summary page open actually briefly? So yeah, thank you all for joining that. We have had a few questions come in beforehand, which we'll briefly go through. We did answer, tried to blend these in as we went through the presentation, really around pension allowances. So somebody has asked about can ISA and SIP contributions be dated back to previous years? Pensions, yes. So you can use the current year and up to 3 years back. So that's a very powerful thing to use, particularly if you've got a higher level of income in one year, or you're earning more money in 1 year and you want to make the most of that. And bear in mind when you are carrying back to using unused allowances from previous years and you are carrying back, that the first year is used first, and then you go 3 years back, use that first, and then come forward as you fill up those pots. You do have to have sufficient taxable income in the current year as well to do a large contribution, or you can do it through your limited company if you are a company director and have your own company. So yeah, we can help with that. Yeah, do speak to us if that's something you're looking to do. But ISA allowances can't be carried back, so if you don't use it, you will lose it. Um, some people have also asked us generally around things like IHT planning, selling properties, those kind of things. And what we would say is if you are concerned about your IHT position, um, just book a call with us. It's always free to speak to us, particularly in initial calls. There's no obligation to move forward with us and take advice with us. Have a consultation, 30 to 60 minutes or so, and just we can understand what your position is, what you're looking to achieve, and if we can help. Um, and then finally, somebody also asked about pension contributions around the £100,000 cliff edge of tax, which Gary, maybe you can touch more on this, about making a contribution to bring your allowance, your taxable earnings, and below £100,000.
Yeah, sure. So what this particular question is regarding is over 100,000. If you don't know, is when someone starts to lose their personal allowance. So it's a particularly sort of like sweet spot in terms of making pension contributions. So by making a pension contribution, it essentially extends your basic rate band, and therefore essentially it enables you to claw back some of that personal allowance. And I think this particular client's asking what happens if they contribute more than 60,000. Is that correct, Fred?
Exactly, yes.
Yeah.
So this particular person was looking at can they make a large contribution? But basically, yeah, I think as Gary said, if your earnings are, let's say you're earning 180, your overall earnings, and you've got unused allowances from previous years and you have cash available, you could make a large contribution, use carry forward, bring your adjusted income down below £100,000, and get that personal allowance back. So it's a 60% tax saving as opposed to a 40 or a 45. So um, I think that's a really powerful piece of planning. Gary and I do that with a lot of clients. At the end of the tax year, look at what your earnings might be, and if there's an opportunity to make a larger contribution. So we have gone over by a few minutes, so I think we'll stop it there. But um, hopefully you've all enjoyed it. We would encourage you all to speak to us if you have any questions. Feel free to email us at advice@netwealth.com. That's advice@netwealth.com. Also on our website, there are various book a call buttons which you can press, and you may have also booked some follow-ups on this as well. They're always available. So yeah, good luck with the planning. Use your ISAs allowances sooner rather than later. I think that's the main thing. Maximise pension contributions this year as well. And yeah, and speak to us, or if you have other advisors as well, speak to them. But definitely speak to a professional and just see if there's things that can be improved in your situation. All right, thank you everyone, and hopefully speak to some of you soon.
Great. Thanks for your time. Bye bye.
Yeah, thank you.